Trading is an industry with way too much misinformation and outright fraud. News outlets, they just want your attention. Brokers want your commission, and trading gurus will try to sell you on that one strategy that actually works, when in reality, everyone is just preying on people that don't understand the math behind trading and how the space actually works. In this video, what I'm going to do is bust 3 trading myths. As a professional quantitative researcher and trader, the only remedy that I can see to this misinformation and outright fraud is education. So in this video, what we're going to do is we are going to tackle these 3 trading myths and disprove all of them with math. Trading is not a get-rich-quick scheme. Guaranteed returns are never true. Unlike access to a Jupyter Notebook with a new Quant Guild video, which is always true, this Jupyter Notebook will be linked in the description below. I will also post it to the Quant Guild library on GitHub, where you can find all of my Jupyter Notebooks and associated YouTube videos, along with all of the source code for my Quant builds. At the top of this Jupyter Notebook, you'll notice some related Quant Guild videos applying probability and statistics to finance and trading. This idea of time series analysis, retail versus institutional trading, trading versus investing, this idea of expected value and accumulating expected value over time, and of course the difference between quantitative and discretionary trading. If you're unfamiliar with any of these ideas, I highly recommend that you check these videos out first before tackling one like this. Moreover, these videos certainly take a lot of effort to create, so if you'd like to help support the channel so I can continue to create videos just like this one, please like, comment, subscribe, share. It helps me out tremendously. It is always greatly appreciated. And if you'd like to master your quantitative skills, check out quantguild.com. Maybe you come from a background in business, economics, computer science. Maybe you're an aspiring quant or a working professional looking to sharpen your quantitative skills. In any case, Quant Guild is for you. We have over 90 quant lessons in math, probability, finance, an adaptive practice engine that scales with your skill level so you can progress to more and more difficult topics with gamified, rank-based progress, interview questions with fully worked solutions, trading games coming soon, courses from A to Z, from the ground up in math, probability statistics, coding, data science, and all that's included with Quant Guild membership. And you can get started right now for free. So if you'd like to help support the channel and master your quantitative skills, check out quantguild.com. This brings us to the first myth, that trading is gambling and the market is random. Trading is not gambling and the market is not random. To understand why this is the case, we need to discuss the difference between a random and an uncertain system. Then we can talk about the difference between a game of chance and a game of incomplete information. When it comes to a random or an uncertain system, the outcome of any event is unknown. This is where they're similar, but where they differ is in the likelihood of those outcomes. A random system has predefined probabilities that do not change for each outcome that might occur. You can think of something like craps, you can think of something like roulette. The probability of red, green, and black in roulette do not change. That is a random system. An uncertain system, you can think of things like poker or the stock market. The likelihood of events occurring over time certainly change, and that is the fundamental difference between the two systems. So if the outcomes are unknown, then how do we evaluate performance? Well, typically we look at expected value, or this idea of edge. Here is the equation for the expected value, or edge, in the context of a random or an uncertain system. And this tells us effectively how our wealth path is going to evolve over time, whether we're going to be accumulating wealth or losing it. Let's look at an example of edge, or expected value, in a random system, that is roulette. There's nothing that a player can do besides martingaling roulette, which is of course going to be banned at any casino you play at, to influence the overall edge of the game. In other words, we've all heard of this house edge. If any player plays roulette, statistically, eventually they are going to lose all of their money. And I have a simulation here where you can actually see what happens to a couple of different players who continue to play roulette. You can see most of them go bankrupt, except for this one lucky guy here who actually made almost double his initial bankroll. And this is where the idea of expected value comes into play. We don't know what the outcome of any one spin of the roulette wheel is going to be. The outcomes themselves are random, but the expected value tells us something about the overall trajectory of our wealth path. So as you can see here, I actually compute it for American roulette, and each play has a negative expected value of negative $5.26. This means on average, every single player that plays is going to lose that amount of money. Now, if they're losing it, then who's gaining it? Well, that's going to be the casino. That is exactly this idea of a house edge. This is a game of chance. This is gambling. There's nothing that any of these players can do to influence that expected value. They have a fixed negative edge against them, and they will always lose all of their money if they continue to play this game. The only optimal decision to make is to not play. So this is a random system. This is a game of chance. This is gambling. Why is the market not random, and why is trading not gambling? Well, to understand why, we need to look at this idea of expected value. Why is this guaranteed by the casino? In other words, mathematically, why do we know the house has this fixed negative edge? This is of a great deal of interest to us because if this was positive, then if we kept playing roulette, we would just continue to make money. So what guarantees that this edge is negative? Well, that is going to be effectively the law of large numbers. This is the strong law of large numbers here. We're not going to focus on the mathematics. We're going to look at a simulation to understand exactly what's going on here. So the law of large numbers is essentially saying if we continue to spin the roulette wheel, then we are guaranteeing probabilistic convergence in a frequentist sense to each of the outcomes that are defined theoretically. In other words, if I continue to spin this roulette wheel, the proportion of red, black, and green that I see is going to converge to the theoretical probability with probabilistic certainty. That is exactly the simulation that you're seeing here. You can see these bars are the relative frequencies that we are observing, green, red, and black, and at infinity, it's going to converge to the theoretical values. In other words, the probabilities of seeing red, black, and green are not going to change over time. They are going to be fixed, and as we continue to spin the roulette wheel, they are going to converge to this value. They are going to converge to this net negative expectation for the player. This is what ensures the house edge, and this is what ensures a fixed negative edge against the players. The probability of winning and losing as a player converges to those theoretical values, and when we plug them into the expected value equation, then we are guaranteed to get this expected value that is less than 0. In other words, players will statistically always lose all of their money. Just like how we don't know the outcome of any one spin of the roulette wheel, we don't know what the outcome of any one trade is going to be. So we can apply this equation, the expected value equation, to trading, and if it is positive, we will be accumulating wealth, and if it's negative, we will be accumulating losses, just as we see here. Now, the key difference between an uncertain and a random system is that a random system has fixed probabilities. Just as we saw above here with the law of large numbers, these probabilities will converge along with the fixed negative expected value. But in an uncertain system, this is not true. This is why when we apply probability and statistics to finance and trading, we are often very wrong. This is because the market is not random. There is no convergence. I have a simulation here to show you exactly what's going on with this idea of an earnings event. So let's say that the market is implying a 60% probability of an up movement post an earnings event and a 40% probability of a down movement. The problem is we can't just simulate that earnings event 10,000 times like we can with the roulette wheel. I can spin the same roulette wheel 10,000 times and see what happens, see all of the outcomes, and record the probabilities, but I can't do that with an earnings event. What you're seeing here is I'm effectively simulating the same earnings event 10,000 times. And what you're observing here is, wow, if we actually had a time machine and we could do that, there is no convergence to the market implied probabilities. They converge to completely different probabilities. And this is literally the difference between the random system, something like roulette, and an uncertain system. That is, in an uncertain system, we don't have fixed probabilities, fixed likelihoods for the outcomes of events that we observe. They are most certainly going to change over time, and our objective is to come up with the best models possible to model the likelihoods and probabilities of these uncertain events. This is exactly what makes the trading space so elusive, because the probability of me winning a trade or losing a trade doesn't converge. My past performance isn't necessarily indicative of future outcomes. Moreover, I dictate the trajectory of my wealth path. My actions that I take directly influence my probability of winning a trade or my probability of losing a trade and my overall expected value. I can always act suboptimally. I can always accumulate an infinite number of transaction costs. That doesn't make it gambling. I can just be a terrible trader. That is the fundamental difference between a game of chance, like roulette, where I just need luck to make money, and a game of incomplete information like trading or poker. In a game of incomplete information, I control my expected value, my edge. My optimal actions in the face of uncertainty are going to dictate the trajectory of my wealth path, just as you see it here. If I accumulate wealth over time, then I'm optimizing my expected value. If I'm losing it over time, then I am doing exactly the opposite. That is the difference between a game of incomplete information, a game of chance, and a random versus an uncertain system. So myth 1, trading is gambling and the market is random, busted. This brings us to myth 2. You only need to be correct 50.5% of the time to be profitable. This one drives me absolutely crazy because I see guru traders talk about their 90%, 100% win rate strategies, and that means literally nothing. You can still lose an incredible amount of money with a 95% win rate. And how that works is expected value. If you take a look at this equation, the outcome, whether or not you have positive or negative expected value, is not dictated solely by the probability that you win, your win rate. It is a combination of the probability that you win and your bet size. I have a simple animation here to show you exactly what's going on. I have a 50.5% win rate strategy and a 30% win rate strategy. But if we operate both, which one actually performs? Well, the 30% win rate strategy is consistently performing. It is the most stable, and it's achieving the results that are intended by the strategy versus the 50.5% win rate strategy, which what? Accumulates losses all the way down to a blown out account. So a win rate has literally nothing to do with the success of your strategy. It's a combination of your win rate and your bet size. This is what dictates your expected value. It can be the case that you have a 90% win rate strategy and you still are operating with negative EV. You have a negative edge and you're going to lose all of your money. So this is the second myth. I talked about bet sizing, but what about this idea of ergodicity? Well, this gets into the idea of optimal bet sizing and whether or not your system is in fact ergodic. This is where things get confusing because you can have positive expected value, but that doesn't mean that you're going to make money on average. Let's see an example of this. I'm going to plot two different systems. I'm going to have an ergodic system and a non-ergodic system. And what I want you to notice is the slope of the expected value line. In both cases, it's positive, right? This red line here is positive. That's the slope of the expected value line in the ergodic system. But in the non-ergodic system, what happens? The slope is also positive. But what is the main difference between the two? Well, let's look at the proportion of profitable traders in both systems. Both have positive expected value. If we look at the ergodic system, we can see, okay, almost 60% of the traders are profitable, 44% are unprofitable, but they're very close to that expected value line. If they continue to trade with positive expected value in this ergodic system, they will accumulate wealth. Okay, but what about the non-ergodic system? Well, let's look at the proportion of profitable traders. Only 20% of them were profitable, but they were operating with positive expected value. What happened? It looks like 80% of the traders are unprofitable. This is because the expected value in a non-ergodic system is dominated by a few very lucky sample paths that accumulate a lot of wealth. In other words, the average case for a non-ergodic system is not the same as the expected value. That means that if I was to trade with positive EV in a non-ergodic system, on average, I can still lose money. So clearly, whether or not we're operating in an ergodic or non-ergodic system is going to be very important. How do we know? How should we size our bets? Well, fortunately, I have a video on this topic and optimal bet sizing. I will leave a link to it in the description below if you would like to check it out. So this is the second myth, that what? You need to be correct 50.5% of the time to be profitable? Absolutely busted. This brings us to our final myth. Myth 3, that trading strategies are fixed, always work, and that nobody shares profitable strategies. All of these are false statements. None of these make any sense if you involve yourself in the trading space, and let me explain why. Trading is quite literally a full-time job. There is no such thing as a golden goose strategy, something that just indefinitely prints money. I can program it into a system, turn it on, and it will always be trading with positive EV. Strategies require constant monitoring and optimization. You have to eventually retire dead strategies or even revive them when they are once again profitable. This is not a trivial task. This is a full-time job. Academic models in the quantitative finance literature can certainly help in understanding where your returns are coming from, but they're often also misleading. So it's a very intricate space to operate in. But in any case, regardless of the type of trader that you are, whether you're a discretionary trader, a market maker, a quant trader, your objective is to maximize your risk-adjusted return. We're not just looking at expected value now. We are also concerned with the amount of risk associated with each trade. So our objective is to maximize literally this equation here, our risk-adjusted return according to some sort of function pi. Pi star is the optimal function. That is going to maximize our risk-adjusted return. Pi star is a function, a collection of actions that we choose to take based on our environment. It is not just a trading strategy. This is built from a combination of knowledge and experience. Nobody, no broker, no news outlet, no guru trader can gift you a pi star function. This is why I always say to master your quantitative skills so you can make your own informed decisions in the face of uncertainty. To better understand this idea of a pi star function and this idea of trading strategies being dynamic, that is, they aren't fixed and they don't always work, let's look at two examples. We're going to look at a price path or an equity curve with an effective policy function and one with an ineffective policy function. And that policy function is going to be our pi or our pi star. What I'm going to do here is I'm going to run this animation, and you can think of this period of 2 years of trading as a back test in some sort of quant trading sense. You can think of it as a discretionary trader trading for 2 years with his account in that sense. In any case, after this 2-year period, we're curious about the forward-looking performance. Maybe there is a regime change. Is that discretionary trader acting with an optimal policy? In other words, does he actually know how to trade in different environments? In the quant trading sense, did we overfit our model to noise, or did we actually find a statistical inefficiency that we can capture? In either of those cases, you can see if we have an effective policy function, then we're going to see stable performance in a forward-looking sense. This is because we are actively and dynamically updating our strategies. We are updating our pi star function. We're continuing to learn. We're continuing to experience. This is not a one and done, a set and forget. We are retiring quant strategies, dead alphas, and we are only trading stable ones. Maybe we even revive dead ones that are now stable again. Our trading model, if we're a discretionary trader, is robust to out-of-sample performance and different regimes, just as we see here. In any case, whether we're a quant trader, a discretionary trader, we are looking for a pi star function, a policy function that allows us to not only perform past tense, we also need to perform presently and in a forward-looking sense. And that optimal policy function is not fixed. And that is really the purpose here, is understanding that, hey, this is literally a job. This is a full-time job. I am going to be making these adjustments continuously every day. I don't just find one strategy that works and I'm done. It is all probabilistic, and I'm going to continue to refine and update my edge. If I don't, what's going to happen is something like this with an ineffective policy function. If I am trading a strategy with alpha decay from crowding, if I'm overfitting a backtest to noise, if I'm a discretionary trader and I'm clinging to that one technical strategy that is not performing well in this regime, then my out-of-sample performance is going to be terrible. This is an ineffective policy. So it all comes down to a policy function. Are you acting optimally in the face of uncertainty? This is not a fixed strategy. This is a collection of actions that dictates your overall risk-adjusted return. This is how we need to look at the space, not just in terms of our simple performance in a backward-looking sense. We need to consider it in a forward-looking sense, because that is going to dictate whether we are actually learning, whether we're going to continue to act optimally, or if we're going to just continue to accumulate negative EV, as we see here with an ineffective policy function. This brings us to the last component of this myth, and that is the idea that nobody shares profitable trading strategies. And I must admit, I find this one quite fun, because it really shows you very quickly whether or not you're dealing with someone that understands this space or not. I see this all the time in my YouTube comments section. Nobody shares a profitable strategy. The edge is going to get crowded out, this, that, the other. And I find it funny because they're not dealing with anywhere near the capital sufficient to crowd the alpha. And even if they could, even if they had the capital, would they be deploying the exact same system to take advantage of the same statistical inefficiency to crowd out that alpha, to crowd out that edge? That is precisely my point here, is saying that sharing a component of a positive EV strategy, a component of an optimal policy function, your pi star, is going to crowd out the edge is utterly outrageous. Now, if we're talking about quantitative like trading, quantitative research specifically, then yes, you can have your alpha crowded in an institutional case when you're dealing with that infrastructure and capital, which is why a lot of times you'll see people on non-competes, you'll see people on garden leave, so they don't just go to another firm and deploy capital to that strategy. But on YouTube, if I'm sharing a general class of strategies with you that you can combine all together in a pi star function to make optimal decisions and improve your edge, no, you're not going to crowd out my or someone else's edge. Largely, I like to think about this in the same way that I think about asking someone to teach me to play baseball. I can tell you the strategy is to hit the fastball, but if you can't swing the bat and connect with the ball, I can't help you. This is why not everyone is a baseball player, and not everyone should be a trader. Not everyone can bear risk. That's what it means to be a trader. And not everyone can make optimal decisions in the face of uncertainty, even if that means cutting losses and changing a strategy. This is not a get-rich-quick scheme. You must have knowledge and experience along with a tolerance for losing money. I can share with you general classes of strategies that work every single day in different capacities. Mean reversion, overstated volatility, momentum, sentiment, but nobody's going to sit there and trade for you. Nobody's going to tell you when to enter, exit, or why, or how to manage your risk, or when it's time to cut those losses. So when somebody says, hey, nobody shares profitable trading strategies, what they really should be saying is nobody is going to trade for you. Yes, that is largely true. I have a great example of this in the context of poker, and this is also why technical analysis can't be disproven outright. And this goes into what we discussed earlier in an uncertain system versus a random system. We can't just run a simple backtest on a technical indicator to see if it works or not. It's going to be a component of your pi star function to aid in decision making. And this really gets at the heart of the trading space. Everything's uncertain, and you always have to adjust and update your assumptions and strategies. That is why it's a full-time job. Let's look at this example with poker and pocket aces. So I'm playing Texas Hold'em against 5 people, and I have pocket aces. I have a pair of aces in my hole cards. So what are the implications of this? Well, the general strategy that I can share with you, if you want to think of it like a general strategy similar to the trading space, mean reversion, overstated vol, momentum, sentiment, whatever it is, the general strategy that I can share with you here is, hey, unconditionally, you have less than a 50% chance of winning, which means more than half the time you should fold. Now, that doesn't necessarily mean that that is going to be your optimal decision to make. This is up to your pi star function. So what I have here is an animation of my player wealth path making optimal decisions at the table, bluffing effectively, knowing who I'm playing against, whether they play too tight or too loose. In any case, my raw theoretical probability of winning is actually less than 50%, but my pi star function, my optimal decisions at the table, actually induced what? A 60-40. And I'm able to accumulate much more wealth than I should with the theoretical pocket aces. This is because I'm forcing people to fold when they actually had the better hand. And this is done through that pi star function, my optimal betting, my bluffing, knowing who I'm playing against, how they play, how many chips they have left, how many chips I have left, so on and so forth. So when it comes to a trading strategy, this is why it is not fixed. We have an optimal policy function, a general set of actions, and we need to continue to update that policy function based on our environment. Just as we see here, we can't just operate with a fixed strategy with pocket aces. What? Always raise this amount? No, it's going to depend on who we're sitting at the table with. And that's exactly true for all of these different classes of trading strategies. They're going to enhance your edge. They're not going to just make it positive outright. And on this channel, I've shared a variety of profitable strategies with you. Cross-sectional social sentiment. I have a seminar on this strategy that was deployed in a quant trading context, and it's one of my least popular videos. Selling overvalued vol. This is how a lot of hedge funds make money. Mean reversion to a calibrated volatility surface. People don't just go out and trade a fixed version of these strategies. It's about enhancing your edge. And in this exact same context, when I've shared these strategies, people demand my P&L. I've shared this in one of my previous videos, and they're still largely dissatisfied with it. So again, regardless of how you operate in this space, we need to understand what is true and what is not true. This entire space is not random, it's uncertain. Trading is not gambling. Being correct a proportion of the time does not matter. It comes down to expected value. And of course, people can share wisdom, experience, knowledge with you. That's not going to make your overall expected value positive. And there is no such thing as this golden goose strategy to make it positive. So that is myth 3, certainly busted. Too long didn't watch. Here's your executive summary. Myth 1, trading is gambling and the market is random. Busted. Trading is not gambling. It's not a game of chance. There is no fixed negative edge against the players or traders in that system, and the market is not random. It is uncertain. There are no fixed probabilities that converge. Myth 2, you only need to be correct 50.5% of the time to be profitable. Certainly busted. This is not true. It depends on your bet sizing and whether or not you are dealing with an ergodic system. Myth 3, trading strategies are fixed, always work, and nobody shares profitable trading strategies. I can tell you exactly how I make money. It does not mean that it is going to continue to work or that you can execute on it or that you will crowd out my edge. Some future topics, technical videos, and other discussions to look forward to. I'm always trying to figure out what's next, so if you have an opinion either way, please leave it in the comments below. I'd like to talk about advanced Markov chains, absorbing states, communication classes, ergodicity, stationary distributions, things you would see in a course on stochastic processes. I want to talk about Brownian motion, arithmetic, geometric Brownian motion, this idea of an additive versus multiplicative process, and in that same vein, discuss this derivation of the Black-Scholes equation, the subsequent PDE, and how to solve it analytically versus numerically, and the connection between the two. I know we also need to tackle this idea of Kalman filters and non-stationarity. This is a big problem in quantitative finance, and our quant models in general really suffer from this idea. I also want to talk maybe more qualitatively about some of the most popular models in quant finance for informed trading, and maybe even the difference between buy-side versus sell-side quants. Don't worry, I haven't forgotten about the quant builds. This week we built the earnings event trading dashboard. I would like to continue maybe with a live Kalman filter model. After we cover it, of course, theoretically, we can implement it in some sort of system, maybe even for trading with interactive brokers. We could include, because we've covered Markov chains and hidden Markov models, regime dynamics as well. If you'd be interested in that, leave a comment below. And of course, we're building towards this automated delta neutral trading system, which I would like to build after we've derived the Black-Scholes equation. I think that will be nice to see come all together. That's going to do it for this video, busting 3 trading myths with math. I hope you enjoyed. I hope you learned something. This video certainly took a lot of effort to put together, so if you enjoyed it and you want to see more like it in the future, please like, comment, subscribe, share. Again, it helps me out tremendously. It is always greatly appreciated. Check out quantguild.com to master your quantitative skills. If you'd like to connect with me and other quants in the Quant Guild community, check out our Discord, link in the description below. Other than that, thank you so much for watching, and I will see you in the next video.